Bloomberg Audio Studios.
Podcasts, radio, news.
I'm Stephen Carroll, and this is Here's Why, where we take one news story and explain it in just a few minutes with our experts here at Bloomberg.
The back and forth between the Fed and the White House, that's not healthy.
Some of those price pressures from tariffs starting to creep in.
The fear you can have is that it's not only goods inflation coming from tariffs, it's also the upside risk to services inflation coming from wages.
It's really beneath the surface that we do still expect to see the impact of policy changes.
Some of these larger structural issues remain.
You know, if you're walking on a lake and the ice is frozen and it sounds safe, but when you start hearing cracks, and that's what I feel like, it's too late once you go through the ice.
There are plenty of big issues out there for investors to worry about. But just days out from Donald Trump's next tariff deadline, stock markets have hit record highs. And volatility, as measured by the VIX, known as Wall Street's Fear Index, has all but disappeared. So are investors just feeling zen, or is the VIX missing something? Here's why there isn't more fear in the Fear Index. Our markets reporter Valerie Tytel joins me now for more. Valerie, first of all, why is the VIX known as a measure of fear?
Essentially, what we know about markets is they tend to go down in very sharp magnitudes over a short amount of time versus going up in a large magnitude in a short amount of time. So we have had days where the stock market drops 20%, right? 1987, Black Monday, stock market was down 20% in one session. We have never had a session where the stock market is up 20%. So that is something that's called skew. And why that's important is because most assets, when you're looking at the volatility of them, have a significant right tail. So there is a significantly higher risk of a larger drop to the downside than there is of a large rise. And so when we look at volatility measures, essentially when we see something like the VIX spike, the market is essentially pricing in the market falling by a large amount. So volatility is a great measure, but what we need to remember is that normally when volatility is rising, something bad has happened to this asset because we know we're more likely to fall off a cliff in the equity market than we are to one day walk in and the equity market's up 20%.
So what exactly does the VIX measure?
Well, that's a fun thing to explain, Stephen. So let's just take where the VIX is trading right now. It's trading at 16. And that is giving us a log normal volatility over the next 3 months. I know that sounds crazy.
You've lost me already. What is log normal volatility?
So essentially what that means is that to back that out into a daily implied percentage swings of the equity market, we have to divide it by the square root of the number of how many trading days are in the year, and that's 252. So we divide it by the square root of 252, which is roughly 16. So with the VIX at 16 now, it's implying a 1% daily swing. 16 divided by 16 is 1% daily swing in the equity market. And how it backs that out, it's an index that tracks various amounts of options on the S&P 500, call options, put options, straddles, all around a horizon that expire in 23 days to 37 days. And it kind of weights that to a 30-day benchmark. So what this is telling us is if the VIX at 16, we divide that by 16, telling us it's implying a 1% daily swing over the next 30 days.
So pretty low, but how has the VIX tracked events like Donald Trump's tariff announcements, for example?
So at times where the actual equity market starts to move a lot, you normally see the VIX rising as well. You know, that happened back at the beginning of the year, April 2nd, the VIX shot up to 60 in the days after Trump's announcement. And that was implying around a 3.5%, maybe 4% daily swing in the equity market. So it is a forward-looking measure, but it normally does take into account what's happened in, the brief history. So like with the VIX trading at 16 right now, we think about what's on the event horizon over the next 3 months. Well, we don't have a lot of central bank decisions. They're all on holiday in August. August is normally a low liquidity time where there's not a lot of trading. So it captures into that horizon. But then it'll also capture things going on in September. So there's another Fed decision. There's another payrolls decision. We do have these ongoing trade negotiations, which are supposed to come to fruition on August 1st. So it does capture in a lot of potential risk events. But what it's essentially telling us now is it's not too worried about it. It's at quite a low number for where it's been trading earlier this year.
It looks like a bit of a shrug, to be honest. Is there somewhere else then that we should be looking for an idea of whether investors are worried or how worried they are? Is something like gold a better measure?
Some would maybe argue that it is, but if you think about gold being driven by other factors like central banks increasing their allocation, mainly out in Asia, China being a big buyer of gold, it can also tell you different things. But it is useful sometimes on a big risk-off move that you do see gold rising, but it's driven by other factors as well. But in a nutshell, what the VIX is kind of telling us right now is that the market has really gotten a tougher skin around Trump trade headlines, around all of the policy uncertainty under Trump's second administration. It just seems like, where before maybe the market was overreacting to every tariff threat, at the moment the market is kind of looking through it in some way, thinking that we more understand Trump's style of, setting the bar really high with a number and then negotiating it down lower. So in some way, maybe the market is just believing that these trade agreements will lower the number of tariffs, and in some way believing that maybe after Trump's tariffs are set, that there's really not a lot of surprises left on Trump's economic agenda. He's already passed the tax bill, a few weeks ago. So it's definitely confusing many investors why all of a sudden the market is starting to look through this policy uncertainty. Whereas at the beginning of the year, policy uncertainty was at high. The equity market was falling out of bed. In April, S&P 500 went down near 20%. It just seems like the market has gotten a tougher skin, and that's reflected in how the VIX is trading.
So is the VIX still a useful measure?
Oh, definitely. It is a useful measure in a way that risk managers likely still use that as a big input into evaluating the riskiness of a equity portfolio. So these measures of implied volatility are definitely used by risk managers to assess how risky a portfolio is. And then at the same time, it is telling us something. It's telling us that the market isn't worried. So obviously, Stephen, we have known many times, especially this year, that the market gets it wrong, and it gets it wrong all the time by a big magnitude. So let's say we fast forward 3 months, and let's say a lot of chaos has happened in between now and October. There's obviously a high likelihood what the VIX is pricing now isn't going to come to fruition, right? It can't necessarily predict the future, but it's a good measure of how investors are viewing riskiness and implied volatility in the equity market, and that does bleed into other assets as well.
Okay, Valerie Tytel, our markets reporter, thank you very much. For more explanations like this from our team of 3,000 journalists and analysts around the world, go to bloomberg.com/explainers. I'm Stephen Carroll. This is Here's Why. I'll be back next week with more. Thanks for listening.